Now, I'm taking an opportunity here to welcome you to our today's session. Today, I just want to look at mergers and acquisition. And in this case, when you are looking on the mergers and acquisition, it means it is a new topic for us. But before we go there, before we get to that mergers and acquisition, remember, last week we were looking at portfolio theory and analysis. I was able to do an introductory part of the portfolio theory and analysis. We did also some of the computation there regarding to the portfolio risk and also what the meaning of the portfolio theory and how the decisions are basically made. I remember that some of you might be prepared. To date, we do the multi-factor models. That is where we normally discuss about arbitrage pricing model. The arbitrage pricing model, I just want to do it separately and independent. But we have things like Farmers French and Pasta Stambo. These things have not been tested recently. And I was able to think of because I have a very good recording, by the way. I have good recordings there regarding to the same. Why should I be able to repeat the same concepts? Whereas you can be able to go through Mwalimu's video and you can just learn and understand that concepts, which I have already elaborated well there. Together with the portfolio performance measures, I have done up to the last question. The question which they tested lastly, it is already included in the video that I will be able to share with you. So in this case, you will be able to look at the things like Shapes measure, Trainers measure, Jensen's alpha, Modigliani and Modigliani. We are looking at, let me just help a student here. Minute, please. So I was just explaining what you are going to be expecting when you are doing the portfolio performance measures. I have said you're going to be looking on because the portfolio performance measures are used to evaluate the performance of the portfolios. I have said they have not introduced or there is no any new concept which has come in regards to portfolio performance measures. And I have said, why should I be wasting all the time repeating again the portfolio performance measures, whereas I can be able to allow you, right? I can allow you to go through it, and then you listen to that video. You look at the areas that you need to, the areas that you can be able to raise some questions. Then when we are doing our blocks, when we're going to be doing our blocks, you can be able to raise the same concept, right? Right. I know that we are in agreement on that. Now, that being said and done, I have said that just help your friend to log in. Now, I just want to look at topic 3, right? A very crucial topic. I know the people who have done advanced financial management for quite some time, they have come across questions of mergers and acquisition every semester. And when we discuss about an acquisition, right, it represents an absorption of one company by another. So the acquisition always, when you look at one of the examples regarding to this, because I know that the term mergers and acquisition, these are not new things to you, sorry. So in this case, we are seeing a company which is known as Predator absorbs another company which is known as Target. There is a concept whereby you're going to be purchasing a company, right? That is in existence, right? So, good. 1 minute. Who has helped Mercy? Somebody should be helping Mercy to come in, please. Let me look at it. I cannot be able to see her here. Okay. Now, when you look on the merger, because already I have explained about what is an acquisition, when you look at a merger, we are saying is where two or more firms come together to form a stronger company, right? Sometimes you can be able to see how things are becoming tough now in our country. And then some companies may tend or may be willing to merge. It means that these companies might be operating in the same. They might be in some instances they might be what should I say? They might be competitors. That it means they are operating in the same line of business. These companies might not be operating in the same line of business, but they want to merge. The reason as why we are merging is because sometimes when we are merging, we might be in need to dominate a market or become a monopoly in a certain area or jurisdiction. So that is where we are saying both companies will be able to terminate their previous legal existence and become part of a newly formed companies. A consolidation is common in mergers where both companies are approximately the same. We normally have the types of mergers and acquisitions. We are discussing of having horizontal merger, and we are saying in this case the merging companies are in the same kind of a business. Usually as competitors, e.g. we are saying two competing banks combining into one. That is why I was discussing of two companies operating in the same line of business. That is what we normally discuss, a type of merger called horizontal merger. Secondly, we are talking about vertical merger, and the acquirer buys another company in the same production, production chain. For example, we are saying that let me look. There is friends of mine who are coming in here. Let us welcome all of them. Now, we are saying that for example, a supplier or a distributor of raw materials, right? A distributor of raw materials merging with a manufacturing firm, where an acquirer purchases another company that is unrelated. That is unrelated. There is an information which I've been looking at, but I cannot be able to find it. Because I just want to give you live examples. Give me 1 minute. I search something here. Now, I was looking on the horizontal merger. Let me just go back there a bit. We said that is a merger between two firms in the same line of business. For example, the merger between the SmithKline Beacon and Glanton will come to form, that is so one of the toughest, which is the toughest name under the pharmaceutical firms in the world. I could remember there was a CIC merging with another. It was CIC and Barclays to form ABSA. Where did ABSA come from? We have different mergers, but when I remember about the acquisition, I know there is an acquisition which took place between a bank called KCB Bank acquired National Bank of Kenya. I know that you also remember there was those kind of mergers. Then we have vertical merger, and these are merger between the firms in different level of production of various components of the same end product. For example, the merger between the tire. When you look at it, there is a merger between a tire manufacturing firm and a car assembly companies. So this merger is thus a combination of two or more firms involved in different stages of production or distributions. It can either be forward or backward in nature. So when we are doing the vertical merger, we normally look at it that what might be the main purpose of doing a vertical merger. And we can say that the main purpose of doing it is to ensure a guaranteed supply of raw materials and eliminate the problems associated with coordination and negotiation with suppliers. For example, you might be serving a company where it is already the only one which is chosen to supply a given type of products by a certain company. So a giant company chooses another company to supply the products, right? To supply the products in that organization, and they don't want, it means that they want full concentration in terms of supply. We normally have another type of merger called conglomerate merger, and we are saying it is a merger between two firms in unrelated lines of business. And the main aim of this type of merger is for risk diversification. I know very well that there are these companies which For example, let me give family bank. A family bank is operating a family bank. When you look on the purpose of the bank is banking institutions is to get the income through the interest and the issuance of the loans upon others. But through the same bank, they were able to come up with an Orient insurance, whereby they are trying to capture different types of clients who want to insure certain risk with them, and they are diversifying the type of risk which might be involved in that nature. Now we have a generic merger, and is a type of merger where the companies are in the same industries or markets but do not offer the same products. In a generic merger, the companies may share similar distribution channels, providing synergies for the merger. So the acquiring company and the target company may have overlapping technology or production systems, making for easy integration of the two entities. So the predator may see the target as an opportunity to expand their product line or gain new market share. Now, sometimes an examiner might be asking you what is the reason or what are some of the benefits of the mergers and acquisitions. And when you're looking at the types of the benefits of it, one, we might be looking on this synergy. And when you look on the synergy, we are saying that there are just additional benefits associated with the economies of scale after the mergers and acquisition. It is a creation of a whole which is greater than the sum of its individual parts. For example, I remember when you are looking on the synergy in aspect of management, we normally talk about 1 + 1 is equal to 3. And synergy is not always achieved in practice due to the following reasons. I can be able to give some reason there. One might be the lack of complete and correct information before the merger. There might be integration. You might be looking on integration problems after the merger due to the organizational culture. And because of being too optimistic about the potential mergers and acquisition. And sometimes it might be due to lack of motivation. That is what we can be able to see. The reason is where we might be unable to achieve synergy. But when you look on the growth, when you look at the aspect of growth, we can be able to see that on the aspect of improvements, the corporate managers are under constant pressure to grow their company's revenues, and they often turn to merger and acquisition activity to achieve that growth. So the company can grow either by making investment internally, that is organic growth, or by buying the necessary resources externally, that is the external growth. It is typically faster for companies to grow externally. Now, another thing that we see the companies trying to do is by we can be able to see increasing the market power, and in industries where there are few competitors or where the market share is sufficiently concentrated, horizontal integration may be a means by which to increase market power. When a company increases market power through horizontal mergers, it may have a greater ability to influence market prices. Taken to an extreme, horizontal integration results in a monopoly. Then we normally talk about acquiring a unique capability resources. Many companies undertake a merger or an acquisition either to pursue competitive advantage or to show up lacking resources. When a company cannot cost effectively create internally the capability needed to sustain its future success, it may seek to acquire themselves, or they may seek to acquire them elsewhere. For example, a company may engage in merger and acquisition activity in order to acquire specific competencies or resources it lacks. Then I will be able to give a last point. We have a lot of points there. We might be looking on a bootstrapping earnings, and we are saying even when there are no reasons to believe that synergies or growth would result from a merger, it is possible to create the illusion of synergies or growth. When a company's earning increase as a consequence of the merger's transition itself, we are saying it is normally referred to as the bootstrap effect or bootstrapping earnings. The bootstrap effect occurs when the shares of acquirer, trader, or trades at a higher price earning ratio than those of the target, and the acquirer's P ratios does not decline following mergers. They have already given you, and because of time, I know you are good readers, you'll be able to go through the points which I've already provided there for mergers and acquisitions. Now, from there, now we can be able to check on another thing here, whereby we might be looking on the types of synergies, and the type of synergies I can be able to provide later. There is a concept here which I just want us to look at, the methods of consideration. The methods of consideration. When we talk about the methods of consideration, we are just looking at the forms of acquisition of a target. A target is a company that we want to purchase, right? And what are some of the forms of acquisition do we normally have when it comes to when you want to purchase one? One, we might be paying, we might introduce a method of consideration through the payment in cash. There is a share for share exchange, which we shall be able to see when we are doing illustrations. Then we have the use of convertible securities. Then we have another one called a combination of any of the above forms. So share to share, we normally say that a predator will be able to offer a given number of ordinary shares to the shares of the target firm. That one we are going to be experiencing it much when we are going to be, or when we are doing our illustrations. But when we are using a fixed income securities, we normally look at aspects of the preference share capital and debentures. These are things that normally form part and parcel of the capital structure of the organization. We will be able to revisit the cost of capital when we are doing the advanced financial decisions later on after this. Then we normally have the cash payment. Sometimes the predator pays cash to acquire the targets without any negotiations. We can pay in cash. So those are the things we can be able to do. But sometimes in the market, for example, there are these companies which are already established. They have established themselves in the markets, and they have enough resources which they can be able to use, right? Let me talk about to monopolize the organizations. And in that case, because utai kushikwa umono in the market, there are some of the defensive tactics which you can be able to use to counter these merchant companies. And one of them, I will be able to give some examples here. We normally have something called the crown jewels, and we say this is where the target sales of the most attractive part of his business that the predator is interested in, or highly valued asset, which in turn make the company unattractive. Crown jewel, you can be able, and we'll be able to see some points here, whereby you can be able to value some of the things which you can see that the predator is targeting. You revalue them, or you can be able to resell those assets. We can be able to use a poison pill, and in this case is where the target undertakes an act that will make it less than attractive, and that can interfere with its going concern. So that is by borrowing heavily or declaring very high dividends. I know right now we are waiting some dividends from different financial institutions. So the dividends every time as a preference shareholder, you normally pray that they are going to be paid at a high consideration. Now, number 3, we have white knight, and we are saying the target gets a friendly predator to acquire it instead. And so the strategy should, however, be used as a last resort, since it results to loss of independence. Again, the white knight may not be unelegant as iniquity thoughts. So usually the target will enlist the services of investment banker to locate a white knight. A white knight company comes in and rescue the target company from the hostile takeover attempt. That is a good concept. Then we have litigation. And one of the most common approaches to stopping a merger is to legally challenge the merger. So the target company will seek an injunction to stop the takeover from proceeding. This gives the target company time to mount a defense. So for example, the target company will routinely challenge the acquiring company is failing to give proper notice of the merger and failing to disclose all the relevant information to the shareholders. We have Pacman defense. As a last resort, the target company can make a tender offer to acquire the stock of the hostile bidder This very extreme type of anti-takeover defense and usually signals desperation. It is based on the rationale that the best defensive strategy is to attack. Now, I will not be able to continue praising these notes because they are so sweet. Examiner normally targets them. We have a very big analysis there, which you can be able to use for analysis and understanding of the analysis of whatever you want to learn there. And that being said and done, you will be able to allow me to focus on the computations, because computations will eventually gives you a good insight of how you are supposed to be doing these questions, right? Or now you're supposed to be doing these questions. So in that regard, I will be able to request you, right? I will be able to request you to allow me to get into analysis of a target farm, right? I just want us to go there. We look on the questions and how they normally be tested, so that every semester, because these questions are coming every semester, we can be able to know how to handle these kind of questions. So in that case, allow me to share my boards, and I shift on the other side. So tunaweza patana huko. Take your calculator, right? Take your calculator and a place to write, right? Just be prepared as I am. 1 minute. So I would like to look at the computations and what are some of the methods we can be able to use when we are valuing a target farm. So in this case, I can be able to write here. We are doing something called mergers and acquisition. I know right now you know what is a merger, what is an acquisition there. So let us just go straight to look at the valuation. Valuation of a target farm. How do we normally value our target farm? And well, number one, you remember there is a method we were using when we were computing the, when we were doing our ratio analysis, or when we are doing the ratios under the section 3. And one of the key methods you use there, number one, we used to look at the computation of the PE ratio, right? The price earning ratio is one of the methods we can be able to use in the valuation of the target farm. So P ratio method, and we are saying, if you can be able to recall, when we were doing our P ratio, we used to say, can you be able to take our market price per share? Right? We used to take the market price per share, you divide by the earnings per share. So in this case, I'm talking about EPS, and here we are talking about MPS there, MPS. Now, and because now we are not computing the PE ratio, we are not computing about the PE ratio, we want to look at the valuation of a target farm, and that mostly focuses on the market price per share. Now, because we want to determine how much do the shares of this company are being valued in the market. If you cross multiply, it means if I want to get the market price per share, it means I'm going to be taking the PE ratio, I multiply by the earning per share. I take the earning per share in that regard. Now, it means if I want to get the valuation of the value of a farm, if you want to take the value of a farm, you can be able to say, if you want to get the value of the farm, let us look at the market price of this share. You multiply by the total number of ordinary shares. Total number of ordinary shares. The total number of ordinary shares, we can be able to check on them. And if that is not available in a question, it means that the question is not wrong. You can be able to take the PE ratio. Then you multiply it with something called the total earnings. the total earnings, or you can talk about the PAT, the profit after tax. You can talk about the profit after tax. You see, now you can be able to use this. You can be able to use these to value an organization, to determine what is the value of that organization. Secondly, we can be able to use a method again we used in the valuation of the ordinary shares under the valuation concept in finance. We used to call it the net asset method, right? We used to talk about number 2 here, the net assets. The net asset method. And we said it uses a balance sheet formula. It uses a balance sheet. It normally uses a balance sheet equation or formula to determine. It normally uses all that to determine the value of equity. The value of equity. So in this case, it means if you want to determine what is the value of equity, right? It means you're going to be taking the total assets minus the total liabilities. The total liabilities, including, we normally include what? The preference share capital. The preference share capital. We are calling the preference shareholders or the preference share capital is a liability because when an organization is making a profit, when we make a profit, these are the people who are waiting now to see whether we can be able to give them something, right? The purpose as to why they are investing with us is because they want to make some profits or they want some dividend out of investment. So that is why we are saying they are part of the liability in the organization. Number 3, we can also use a method you use to value the ordinary shares. And that method we used to call it Gordon's. We used to talk about the Gordon's dividends growth model, right? The Gordon's dividend growth model is a method that's used to value the ordinary shares, all right, under the valuation of the ordinary shares. And these concepts we talked about, a Gordon being a very good concept in the analysis, whereby it normally analyzes the organizations which we used to talk about non-growth firms, normal growth firms, and then we used to discuss about the supernormal growth firms. If you can be able to recall the formula you used to use when you are computing, when you are doing your computation, right, under the supernormal growth firms, we used to say, let me start with the normal. Let me start with the normal farm. Let me start with the normal farm. You remember when you are doing for the normal farm, we used to say, to get the market value, we are going to be taking the O, 1 plus G. You divide this by KE minus G, right? KE minus G. You remember now we are talking about the normal farm. This is the formula that we were using to get the value of the farm, not the market value. Now, in this case, this is the minimum required rate of return by the providers of the capital. Then these are the dividends already paid. These are the dividends that you are going to be paying. This is what we normally talk about, the growth rates. And then this is our what? I remember very well, you remember them. This is the cost of equity. Cost of equity. They are those people who are coming from the lower side. Now, but when we are discussing about number 2, we used to have supernormal growth funds, right? The supernormal growth funds. And when we were discussing about the supernormal growth funds, we used to say that the intrinsic value is the total of 2 components, right? Now, the intrinsic value here, we used to say the intrinsic value is in is the total. Let me use that term, is the total of two components. Which are these components we are discussing about? Number A of the components, we used to say, can we be able to get the present value of the expected dividends? The present value of the expected dividends. The present value of the expected dividends. The present value of the expected dividends. That is what we used to talk about B1. Right? Up to the stabilizing point. Up to the stabilizing point. At this point, we used to use a formula which we used to say D1 is equals to DO 1 plus G. We used to discuss something like that. Up to the stabilizing point, this is the formula that we were using. Then number two, we used to talk about the present value of shares. The present value of shares, that is PO, right? We are saying immediately after stabilizing, right? After stability. Now, in this case, we used to say, to get the present value, which is PO, we used to say to get our PO, we are going to be taking DO, 1 plus G, you divide it by what? KE minus G. That is the formula we used to say. Then the answer, we used to discount it. This answer, we used to discount it to get the present value. These are the things which I'm just reminding you. I know very well that you are able to cover them under section 3. Now, after analysis of such, there are some of the methods which you cannot forego as long as you are doing mergers and acquisitions, right? Let me just put N here. There are two good formulas here. You cannot forget, right? What are these formulas? Let me see here. These formulas you cannot forget. You can't. These formulas you cannot or you can't forget. Number one of the key formulas here, number one, we are talking about the maximum exchange ratio. So what is the maximum exchange ratio? We say we normally take the offer price of Predator, the offer price of the Predator, you divide it by the MPS. The MPS of Predator. The MPS of the Predator. That is one. The second formula here, you cannot be able to forget. The other formula here, you can't forget. It is normally called the non-dilution. Number two, non-dilution offer price of the Predator. Non-dilution offer price of the Predator. We used to take the pre-merger P ratio, the pre-merger P ratio of Predator. We multiply it with the pre-merger. Multiply this with the pre-merger earning per share of the targets. The pre-merger earning per share of the target. Now, mimi nimeandika vitu mingi, I've talked a lot. I just want us to do some illustrations. 4 illustrations. 4 of them. And once we finish 4 illustrations, I will just be able to leave that topic to you and Kasnebe. So we will be able to start with a question here. This question they were able to test the other day. There is a question tested December 2023. There is a question there. December. Who is reading for us? December 2023. Waje tusikize maswali hapa. I said you download my loft. It's very good for questions. Visibility.
So, where are we? December 2023. Hii ndio swali mlifanya, ukasikia ikiwa ngumu kabisa. So someone to read the question.
Kubwa limited dogo. Someone please. Someone to read the question.
Okay. Kuba Limited is considering acquisition of Dogo Limited, a firm in an unrelated line of business in order to diversify their risk. Selected financial data for both firms are provided as below. Additional information. Kuba Limited is considering financing the acquisition of Dogo Limited using share of the share exchange or share debenture exchange. Number 2, corporation tax rate applicable is 30%. Required non-diluting maximum exchange ratio. Number 2, the post-acquisition earning per share, assuming an offer price is set at 30 shillings per share. 3, the post-acquisition EPS, assuming 1,000 ordinary shares are exchanged for 10 units of 15% debenture with the par value of 100 shillings each. Considering your results in B2 above and B3 above, advise the best financing plan. Yeah.
Okay. You're being given a very good question there. One is about a minute, please. One minute, please. So we are being given a question like this in an exam. The examiner is asking you to calculate the non-diluting maximum exit ratio, giving you 3 marks. Then number 2 there, they're asking you about the post-acquisition earning per share, assuming an offer price is set at 30 shillings per share. Then we are also being told that the post-acquisition earning per share, assuming 1,000 ordinary shares are exchanged for 10 units or 15% debenture with a par value of 100 shillings each. Then considering your result in B2 and 3, divide the best financing option, will be able to do so. Now, that being said and done, it's very important to understand how do we normally calculate the maximum exit ratio, right? The maximum exit ratio. So the question that we are doing is the December 2023. December 2023. It should be question number what? December 2023, we have question number 3B. Question number 3B, thank you. Now, the first thing that an examiner is asking you is to calculate, number 1, the maximum exit ratio. And because we might not be able to know what we are doing, I can be able to say, to get the maximum exit ratio, we normally take the maximum price payable, right? You divide it by the market price per share of the predator. Then you come down here and you say, I don't know how to get, the examiner has not given me the maximum price payable. You say, to get the maximum price payable, right? I just said to get the maximum price payable, we are going to be taking the P ratio. The P ratio should be for Predator. We multiply by the earning per share. It should be of the targets. The earning per share of the targets. Let me see. Now, in this case, now, we say, now, to get the P ratio of the Predator, you remember very well we said we normally take the market price per share over the earning per what? The earning per share. But the examiner has not given us the earning per share of the Predator, for example. The earning per share of the Predator. Then in this case, we can say, can we be able to take the total earnings? The total earnings, you divide by the number of ordinary shares. Unajiuliza vizuri. Who examiner amenipea total earnings? We say no. But we can be able to get our total earnings. How am I going to be taking the total earnings? When you look on your question for Kubwa Limited, they have given you a sales of 100. Then we subtract, right? The cost of sales is 30. Plus, we have operating cost of 10 plus 5. 5 is the finance. I can see we have the finance cost of 5. This translates to 45. So when you take 100 minus 45, you're going to be getting 55. So your total earnings, you have a total earnings of 55. So to get your EPS, you say, can I be able to take 55 divided by what? You divide it by 10, getting 5.5. Getting 5.5. So in this case, when you go back there to calculate the maximum price payable, right? The maximum price payable, we are going to be taking what? We are going to be taking 40, which is your market price per share. You divide by 5.5. You multiply it with what? You multiply it with what? Let me see there. 50, 40. Let me see what we are getting there. Very good. So when you look at the, for example, now, you know the total earnings which we have here. These are for the Predator. Right? Those are the total earnings for the Predator. You ask what about for the targets? For the target, you do again, you take 50, then you subtract. I can see we have the cost of sales of 10, operating cost of 5, plus 2, which is the finance cost, getting something closer to 33. Then this one you divide by 7. The 7 is the number of ordinary shares of the targets, getting something closer to 4.71. Right? Examiner hapo alikuwa amewaweza sana. 4.71. So in this case, remember, this is the earning per share. It is the earning per share of the target. You multiply it here. 4.71. 4.71. And that is how you are getting 3 marks. So in this case, I just need to say, let me take 40, divide by 5.5. Then I multiply by 4.71. The maximum price payable should be Kenya shillings. Should be Kenya shillings 34.25 per share. Right? 34.25. 34.25 per share. Is it per share? What is that? 4.25 is the maximum price payable. The maximum price payable of ours is 34.25. So in this case, it means the maximum exchange ratio. To get the maximum exchange ratio, it means now we are going to be taking 34.25, which is the maximum price payable. It should not be per share, right? Now, that 4.25, we divide by the market price per share of the Predator. The maximum price per share of these people should be 40 shillings. Should be 40. So how much is this? What is the maximum price payable? We say it should be Kenya shillings, 0.856 per share. 0.856. Anyone who has not understood, you can raise your hands. You can be able to raise your hand there. The other thing is not number 2. When the examiner is asking you a very simple question there, what is the post-acquisition earning per share? Post-acquisition earning per share. Post-acquisition earning per share. And when you are taking the post-acquisition earning per share, what we normally say, it is, can we be able to take our combined incomes for both companies, the combined incomes, then we divide it by the total number of ordinary shares. The total number of ordinary shares. That is how you normally get the post-acquisition. You normally take the combined incomes, then you multiply by, or you divide by the number of ordinary shares. So how much is the number of the ordinary shares? So in this case, let's start by looking on the combined incomes at the part of the question. So the combined incomes in easy mepata. The first one, the total earnings of it is 55. For the target is 33. So we just need to say, we are taking 55 million plus 33 million. These are net incomes. These are the net incomes. And you can see where they are coming from. If you are following, then you divide it by the total number of, we are going to be considering the percentage which we are using for the exchange when we are converting the number of ordinary shares of the target. So for example, we can be able to copy the number of ordinary shares for the predator, which is 10 million plus, right? What is the maximum exchange ratio unless we are given a new one? Yes, they have already given us a new one. They have said, we are not going to be using the maximum exchange ratio of 0.856, no. We are going to be calculating it since they have given us an offer price of 30, right? Then it means our new, the maximum exchange ratio, right? The new one should be, you take the offer price of 30, then you divide by the market price of the predator, which is 40. Where is the 30 coming from? It is the new maximum price payable they have already given us in the question, right? They have already given us in the question. So that is already there. Then we have our 40. When you take 30 divided by 40, how much are you getting? 30 divided by 40. 30 divided by 40, right? Which is equivalent to 0.75. This is the maximum price. This is the maximum exchange ratio of the shares of the target. So one share, you're going to be giving us 0.75. What about the total number of shares they have? They have 7 million. So in this case, it means we are going to be taking 0.75. We multiply it with, how many shares do they have? When I look at the number of shares they have 7 million. Then I can be able to ask you, can you give us the post-acquisition earning per share? Hiyo swali ikuja kwa mtihani the simplest, by the way. The post-acquisition earning per share. You can see you just need to take the total incomes, then you convert the shares of the targets very quickly. Now, ushamaliza kufanya namna hii. You just need to say 0.75. You multiply by 7, right? Plus 10. You're getting 15.25. Then 55 plus 33 is 88. You divide by my answer, getting 5.77, right? 5.77 per share. 5.77 per share. The third question is asking us a very simple thing there. They are asking, number 3, that the post-acquisition earning per share, assuming 1,000 ordinary shares are exchanged for 10 units or 15% debenture, they're asking us with what? 15% debenture with par value of 100 shillings each. Now, in this case, when you are handling question number 3, because I will be able to give you number 4 for advice, wewe ndio utaenda kwa device. So in this case, based on the knowledge yenye utapata hapa. Now number 4, they are giving us a very good exchange here. They are telling us that what will be the post acquisition earning per share if 1,000 ordinary shares are exchanged with 10 units, right? Very simple. This information comes for the part of the target. So you say if 1,000 shares equal to 10 units, correct? What about the 7 million shares? Itakuwa ngapi? How many units are we going to be having there? Of debentures, the units of debentures, the units of debentures. So in this case, you say, right? You say, let me take my 7 million here. You multiply by 10, right? Then you divide it by 1,000. By 1,000. It means we are going to be having 70. Is it 70? There should be 70 units, 70,000 units of debenture. 70,000. There should be 70,000 units of debenture, right? 70,000 units of debenture. But each debenture is given a value there. Each debenture imepewa value pale. So they have told us each debenture is 100 shillings. Each debenture is 100 shillings. Each debenture, because they have been telling us that the post acquisition earning per share, assuming 1,000 ordinary shares, are exchanged for 10 units of 15% debenture with a par value of 100 each. Already you have gotten 70,000 units. Or they are not 70. I think they are supposed to be 70 years. These are 70,000 units. And you say, if 1 unit, it has a par value of 100, sorry. What about 70,000 units? Very simple math here. It means you're going to be having something closer to 7 million again. 7 million. 7 million there. 7 million. You have not gotten what they are looking at, right? 7 million. 7 million, right? Hatujapata jenye tunatafuta. Now, to get your post acquisition, it means you have talked about
I hope I can.
sorry? Hello? Someone has said something. There. So there is a formula I just want to write here. Post acquisition earning per share. So allow me just to check on it because I like to give you the correct one. So let me get the correct answer for you there. 1 minute too. Not any other proposal. So we have said, if you want to get this, you're going to be taking the total income. The total income, you minus after, this is normally after tax interests, right? Then you divide by the number of ordinary shares. The number of ordinary shares. Now, what is your total income here? The total income of viewers, you look on the total income. When you look on the total income, your total income is 88, as you could be able to see here. It should be 88 million minus after tax. In this case, for example, what is our interest? The interest, you are going to be taking the one given by the examiner here. The examiner has already given us an interest of 15% of the debenture. So I'm going to be taking 15% times 7 million times 0.7. Where the 0.7 coming from? The 0.7 is coming from 1 minus the tax, right? 1 minus tax you're going to be getting 1 minus 7, 1 minus 0.3, getting 1 point that. Then after you finish doing so, we divide it by, right, the number of ordinary shares now. Right, the number of ordinary shares. In this case, we are not going now to be focusing. The number of the ordinary shares should be for the predator. So you divide by 10 million. 10 million now. What is the post-acquisition earning per share? What is the post-acquisition earning per share? Why are we lacking? Why are we not putting the 10 million here? Because we have already converted them. We have already converted the whole shares. So there is no any way you are going now to be saying, Mwalimu, why are we not taking the maximum exchange ratio? We multiply by the number of already ushazi convert hapa. Ukapata the par value, right? The par value of these shares of ours will be 7 million. And that is why we are getting the after-tax interest, which we are calculating up there. So when you take your calculator out, when you take your calculator here, take your calculator, right? Take your calculator, and you give me the answer here. What will be the answer? So in this case, it means I just take 0.15, I multiply by 7, I multiply by 0.7, right? Then you take 88, 88 minus answer, you divide it by 10. You're supposed to be getting 8.73, right? 8.73 Kenya shillings per share. 8.73 per share. So when you're going just to be looking on the on that note number 4, you're going to be comparing between the post-acquisition and this one, and then your device, right? Which one has the highest earnings? That is where your comments are going to be coming from. That is where the comments will come from. Where the comments will be coming from. Any question? Someone to pose a question? Ask me a question before I do another one. Do you have a question? Babe, is everything okay? Is everything okay?
Yes.
Hello? Hello, are we okay? You have to talk to tell me whether the question is okay. Cecilia, is it okay? Cecilia. Okay, nobody is able to unmute. Meshach.
Yes. It's okay. It's okay.
Sorry? One is okay. Okay. I want us to do another question here. The question of merger conditions are very many. Now, let's try to do another question right now. Another question straight away. We can do a question they tested on April 2022. April 2022. April 2022, correct. April 22, they tested a question. Na hizi maswali ni za mwisho pale. So at the moment you are getting that past paper, uone swali ya mergers, already unaanguka immediately. Right. You can see where it is. Na inafuatiliwa na decision tree. Someone to read the question, please. Someone to read, please.
Songo Ltd has decided to acquire Tulka Ltd. Okay. The financial data for the two companies are given as follows. Net sales profit after tax, number of issued shares, earning per share, dividend per share, total market capitalization. Required pre-acquisition market price per share (MPS) of the combined firm, post-acquisition earning per share if Twiga Ltd shareholders are to offer a share of shilling 30 on a share for share exchange. If the PE ratio of Songo Ltd drops to 12 times after the acquisition, determine the firm post-acquisition market price per share. Formulate a suitable criteria that should guide Songo Ltd in determining whether to acquire Twiga Ltd or not.
Thank you so much. I can see an examiner there trying to ask you a very simple question regarding to acquisition market price per share of the combined firm, and they are providing you with 2 marks there.
So this is how you normally get the pre-acquisition or the pre-acquisition market per share. So when you're calculating number 1, pre-acquisition, market price per share, you normally take, for example, in our case here, we have to be taking the combined. We normally take the combined market capitalization. Normally take the combined market capitalization. We divide by the number of ordinary shares. Correct. So in this case, the pre-acquisition, let me check here from your question. Now pre-acquisition, we are going to be starting by looking on the combined market capitalization. And in this case, let us start with the Song and Twiga Limited. And Twiga. Right. So wakati wamenipea swali kama hii, let me start by looking at the number of let me start by looking at what is our market capitalization in this case. So in our case here, we are being told the total market capitalization for Song, because we want to get the market price per shares, right? So we just say here, to get them, let me take the total capitalization for Song is 420 million. You divide it by what? 420 million, you divide it by, we are talking about the number of ordinary shares. So in this case, for example, for Songo, there should be Songo, number of issued shares 7.5 million. Then for the other person here, it should be 45 million. We divide it by what? 45 million we divide by, it should be around 1.5 million. 1.5 million. Someone to give me the answers? Someone to give me the answer? Someone to give me the answer? Nobody can give me the answer? Let me give myself the answer. So for 20, you divide it by 7.5, you are getting Kenya shillings 56. Then we have 45 divided by 1.5, we are getting Kenya shillings 30. But ushamaliza hapa, ni vizuri hata tupate the maximum exchange ratio because we are going to be using it under the requirement part 2. What is the maximum exchange ratio? We say we normally take the maximum price payable. The maximum price payable, we divide it by the number, right? The market price per share of the predator. Correct.
So what is the maximum price payable? The maximum price payable. How are we going to be getting it? The maximum price payable, we are going to be getting it by taking what? The maximum price payable, we are going to be taking the P ratio. You're going to be taking the P ratio of the predator. We multiply it by the earning per share of the target. There. So do we have the P ratio? So in this case, we look on the market price per share. We just remember the formula for the computation of the P ratio. So in this case, do we have the market price per share? You can see we are already given the earnings per share there. They have given you the profit, so that's the dividends per share provided. But the question is, have they provided you with the market price per share? What is our market price per share? And we remember very well, we said to calculate the market price per share, we are supposed to be taking what? The maximum, the market price per share. How much is our market price per share of the predator? Someone? Someone to tell me, how much is the market price per share of the predator? Someone. The market price per share of the predator is how much? Nobody is seeing the market price per share of the predator. How much is the market price per share of the predator? If you are here, you can be able to tell me. Because our formula will be the market price per share over earning per share. We multiply by the earning per share. This is for the predator, this is for the target. Now, the market price per share of the predator is how much? Correct. The market price per share, you can see we were able to compute it here. It should be 56. You divide it by the earning per share. How much is the earning per share of the predator? I can be able to see an examiner has already provided it. Is 3.75. We multiply by the earning per share of the targets, which is 2.5. So how much is this? How much is the maximum price payable? The maximum price payable now. So you can be able to do it. So you say it is 56, you divide it by 3.75, you multiply by 2.5, getting that 7.33. Getting that 7.33. Now, when you get back now to the calculation of the maximum exit ratio, we are taking that 7.33, you divide it by the market price of the predator. The market price of the predator. Now, the market price of the predator you are able to get is 56. So how much is the maximum exit ratio? Remember, swali ya kwanza iliishia somewhere here. But because this is available or being used in the requirement part 2, I said, let us do it. So when I divide by 56, I will be able to get 0.67. 0.67. Now, when you go to the requirement number 2, which is now very simple, they're asking you about the post-acquisition earning per share. Now, when it comes to the post-acquisition earning per share, it means I'm going to be taking what? I'm going to be taking the combined income. You divide it by the number of ordinary shares. And then in this case, we are talking about the total, right? The total number of ordinary shares. Now, how much is the combined income? How much is your combined income? So when you look at it, an examiner has already provided you the income there. I can see we have the profit after tax. No, the market capitalization, sorry. So when you look at it, your total, or which we are the market capitalization of ours, we are given how much? We are given 420. They go to no. Let me read no, I'm not yet finished to calculate the. Sorry for that. Sorry. We were looking on the pre-acquisition market price per share. Pole son. So if you are doing the pre-acquisition here, so we said we normally take the combined market capitalization, that is taking 420 million upon Mekosa plus 45 million, right? We divide it by the number of ordinary shares. How much is your number of ordinary shares? In this case, we are going now to be taking our maximum exit ratio to convert the shares of the target. So in this case, the shares of the predator, which is 7.5, of the predator, which is 7.5, plus now, can we be able to convert the 1.5 for the target using the maximum exit ratio? So we say 0.67 and multiply by 1.5. Sorry for that. Sorry. What is your answer there? Sorry for that. So it will be 0.67. We multiply it by 1.5, right? Plus 7.5, right? So if you take 420, you add 45. Then you divide by my answer. We are going to be getting how much? Let me see. 420 plus 45, that is 465. So 0.67 times 1.5. How much is our answer? Someone? $465 divide by my answer. We should be getting something closer to the pre-acquisition market price per share should be Kenya shillings 54.67. 54.67. Now, when you get to note number two, we have been told the post-acquisition earning per share if Twiga Limited shareholders are offered a share of 30 on a share for share exchange. So it means you have to be calculating your maximum exit ratio, right? Because we have a new maximum price payable, which we have been told is 30. Then you divide it by the market price per share of the predator, which is 56. So how much is this? So 30 divided by 56. 30 divided by 56 is how much? 30 divided by 56. You're getting something closer to 0.54. So to calculate your number two requirements, it means I'm just going to be taking the combined. Those are the PAT. I've already been given as 28.13 million plus the income on the other side is 3.75 million. Then you divide it by the total number of ordinary shares. In this case, when you look on the total number of ordinary shares for the predator is 7.5 million plus 0.54. We multiply it with the shares of the targets, which is 1.5. Then you do the same again, 0.54 times 1.5, right? Plus 7.5, getting 8.31, so 20.13 plus 3.75 divided by 8.31, we are getting something closer to 3.84 per share. 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 Then I can see we have requirement number 3 there. We are being told if the P ratio of Songs Limited, Songo Limited, sorry, drops to 12 times after the acquisition, determine the firm's post-acquisition market price per share, right? So in this case, the examiner is asking you to calculate. Examiner is asking you to calculate a very simple thing there. Let me finish up with this. It means tomorrow we have also to do another 2 questions as we shift to our new topic for better understanding. So when you are looking on the post-acquisition, the post-acquisition market price per share, it means we are going to be taking, we are going to be looking at, what are we doing here? In this case, we are being told, sorry, if the P ratio of Songo Limited is going to be dropping to 12 times. So what will be the market price? What will be the market price per share? Okay. So if it drops, what are you supposed to be doing here? It means that to get the market price per share, we said, let us take the PE ratio, we multiply it with the earning per share. The earning per share, right? And when I look on the earning per share, should be of the target. Remember, the P ratio here is for predator. And we are not going to be computing it because it's already given. We are being given 12 times. We multiply by the earning of the targets. The earnings of the targets, we are being given as 3.75. 3.75. So how much are we getting here? How much are you given? How much is your answer? Post-acquisition market price per share should be how much? So when you take 12 times 3.75, we are getting Kenya shillings 45. We are getting 45, right? Eventually, you can be able to take something like this. If it's not provided, let me see. If you take 28.13 plus 3.75, getting that 1 point, let me see something here. Just want to teach you everything. Then you divide it by the shares of ours. Our shares ilikuwa ngapi? The shares from one side is 7.5 plus 7.5. We add 0.67 times 1.5. We are getting 1. Okay. So 28.13 plus 3.75. 8.5. Divided by 8.5. Correct. So it means if this is not provided by the examiner, if it is not provided by the examiner, then it means also you can be able to use the post-acquisition earning per share. Because if, for example, you are taking the total earnings, I think that is what we were able to get up there. There is an area where we were able to get that. Let me see. If, for example, you take our original now, our original exit maximum exit ratio, which was 0.67. If you take the post-acquisition earning per share, it means if I take 28.13 plus the other one is how much? 3.75. You divide this by the number of shares here. The number of shares of the predator should be 7.5 Then you add 0.67, which was our original maximum exit ratio. We multiply by the shares, you should be getting 3.75. Right? That one you can be able to use it here, if it is not provided. If it is not provided by the examiner. Now, after doing that, note number 4, I can see an examiner is telling us to develop something there. We develop a suitable criteria. You develop a suitable criteria. So the suitable criteria is basically based on pre-acquisition. Is based on the pre-acquisition market price per share and earning per share. The market price per share and the earnings per share of the Songo Limited, compared with the post-acquisition. Compared with post-acquisition. We normally compare with the post-acquisition figures. So in this case, unakuja hapo naniambia, let us look on the pre-acquisitions figures. Then we also look at the post-acquisition figures. Correct? So we are going to be taking the market price per share for the pre-acquisition was 56. Here, it was how much? 54.70. Then the earning per share, the pre-acquisition was around 3.75, correct? Then when you look at the post-acquisition still remains at 3.75. You can be able to see it there. So in this case, you can be able to say the market price per share will reduce from 56 to 54.70, but the earnings per share, will remain the same. The earnings per share will be able to remain the same. That is how the question is basically done. That is how you are supposed to be able to do it. Now, I feel we are supposed to be doing another 2 or 3 questions. Number 1, there is a question at May 2021. There is a question there, May 2021. May 2021, there is a question number 4. May 2021, question number 4. You can see now people are exiting to go and sleep. Then there is another question which I'm supposed also to do for you for better understanding. That question was tested on May 2019, question 5B. May 2019, question number 5B. There is another question also, which is supposed to still need my attention. September 2021, we have question 5C. September 2021, question number 5C still needs me to interpret it for you. If we are able to do these questions, then it means any question the mergers of acquisition, which is going to be coming in an exam, this sitting, you are capable of doing it. Right? So I will be able to stop at that point unless there is any question until tomorrow.